All right, it's time for me to bring in Kumar. Thank you so much for joining us on Investors Guide. It's a pleasure to have you. Let's get straight to our first question. Gregory Saldana has written in. He tells us he works as the operation manager with a take-home of 70,000 rupees a month. This is the great part about this question, Dhirendra. He sent us details: term cover 1 crore rupees, health cover of 20 lakh rupees, 2 lakh rupees set aside for emergencies. So he's checked all of those boxes. He has about 20,000 rupees going out as an EMI every month, and he saves between 30 or 40,000 rupees. Interestingly, his first goal is to increase his emergency fund and make it stronger to about 4 lakhs. He also tells us he'd like to go back into business in the next 10 years, and he wants to set aside a certain amount of money for that as well. He wants to know how he should go about doing that and what your advice is. He sent us a list of the mutual funds that he's invested in. But first I want to ask you this, Dhirendra. The corpus that he has set aside for his emergency fund and the money he's going to be adding to it, where should that ideally be placed? Should it be in a savings bank account the way he has it, or would you like him to use a fixed deposit perhaps?
He should consider one of the three things. One is, of course, a small amount of money should certainly be there in his savings bank account, but of the 4 lakh rupees or 5 lakh rupee, even adding his short-term need, which is 3 to 4 years time, that money can well be in fixed deposit, which is linked to the savings account, which means that that money should be accessible anytime. The other option he can consider, if he's very unlikely to need that money, but he wants to have the safety net of the emergency fund accessible at a short notice, he can also consider an ultra short-term bond fund, which will give him an incremental 2%, 2 to 2.5% more. That could be quite meaningful on this sum if this money is lying there for 3-4 years. That apart, he should try and do this investment online so that he's able to make the redemptions without doing any rounds, if he can actually execute his redemptions online, and most fund companies provide this mechanism.
All right, so ultra short-term bond fund, fixed deposit or savings bank account. Then very quickly, if I'm going to choose an ultra short-term bond fund, and this is a question we hear from viewers on a regular basis, how do we pick one from the other? They all seem, largely similar. Tell us what to keep in mind if you were to choose one.
Ultra short-term bond fund, they work in a very narrow, they're all anchored to very narrow variables, and their return ranges are not wide enough for you to choose. But I would say that keep it simple. The fund which a fund which is big enough, has lower expense, and go by our rating. And I don't think you can be that choosy with the ultra short-term bond fund the way you choose an equity fund.
All right, speaking of equity funds, Dhirendra, let's take a look at his equity portfolio. He began about 3 or 4 years ago, he tells us. These are the funds in his portfolio: HDFC Top 200, Franklin India Growth Companies Fund, Reliance Pharma, and Reliance Small Cap Fund. There isn't a very clear thought between putting these together. I'm not sure why he needs the Pharma Fund at all. But if you're looking at his goals, he wants to accumulate money for the next 10 years and then again for the next 20 years, so long-term horizons. What would you like him to do with this portfolio?
No, I would say that he has chosen good funds, except for that pharma fund being there. And looking at this portfolio of three funds holistically, I would say it's an aggressive portfolio. And his nearest long-term goal is still 10 years away, so he can well carry on with that. Or he can consider mapping his portfolio to our aggressive growth portfolio.
Dhirendra, we have another question from Kalyan, who's written in. He's 46 years old. He has absolutely no savings till date, and that's something he should really worry about. He says next year onwards, he'd have about 75,000 rupees every year as an income that he can spare. He wants to know how he should invest this money right now to create a retirement corpus. He also very interestingly says that he wants to look after the expenses of his wife after his death, which of course is worrying because he has no health insurance and he has no life insurance. The other question he has asked us is that since markets are booming, should he keep his money in an FD right now and move it into equity when the markets are in a bear phase? So we're going to get to that point in a little while. I want to first address the fact that here is someone with no savings at all at 46, and he obviously has a family. Where would you like him to start?
One is that he should look at it as an emergency. He should get a term cover and he should get a health insurance. Otherwise, no investment plan can succeed just in case he goes wrong. And also, going by his age, such a possibility can't be ruled out, and that could be a big derailment for any of his savings plan. So these two things are ahead of your investment plan. Then I would like to keep it very simple, given his age and he's 46. He will also be very apprehensive, and he has never invested before. So I would say that he should just choose 1 or 2 balanced funds from our stable growth portfolio, get started as early as possible, and not look at it for next 2 to 3 years. If you are able to accumulate these savings till your retirement, I don't think you will have to worry about the financial well-being of your wife in your absence.
All right, Kalyan, so here's the advice you're getting. Health insurance and life insurance. That's a pure term cover that you have to buy today. Do not wait even till the end of the day. You have to do it absolutely now. Of course, because you're starting out at 46, it is going to seem a little expensive, but it will be worth it. That, of course, takes care of any sort of medical emergency you have and the possibility of your wife's expenses after you pass on. So then 2 things you don't have to worry about. And then Dhirendra asking you to pick 1 or 2 balanced funds. Those funds are on your screen. Just invest in them as an SIP. Dhirendra, this question keeps popping up again. Kalyan is asking us as well. Is the market overvalued? Is effectively what he's saying. Should I wait until there's a bear phase before I start investing? So what is your recommendation to anybody who has this question right now saying, oh, the market does seem like it's run up a fair bit. Maybe I shouldn't start investing now?
You will keep waiting. You will never invest because, 6 months back when the market was still depressed or, was way of, lower than where it is today, people were waiting that it'll dip further. Now people are waiting for correction. And, I think it's a futile exercise. None of the fund managers I have dealt with or I have interacted with in the last 20 years have been able to successfully call the market. And I don't think that, individual investors can do that. If at all you have to do that, do it in a different manner. Do it with an asset allocation. Do it in a manner that, you have decided that 80% of your money should be in equity, 20% in debt. Because the market has gone up, do a rebalancing annually. So you'll be booking profit when market goes up, which means, and your allocation becomes different.
All right, so Dhirendra is making it very clear, and this is the best part about the advice you get on the show. It's really, really simple. You don't have to time the market. You don't have to do anything fancy. Start an SIP, invest regularly, and forget about it. That's all you really need to do. We have another question from Salim, who's written in. He's a dentist, Dhirendra. He has 10 lakh rupees to spare right now. He wants to invest it for 5 years. And he sent us a very open-ended question. He's saying, should I invest it in real estate? Should I invest it in insurance policies or in mutual funds? Salim, let me first make this really simple for you. You cannot invest in real estate for 5 years. It's just impossible to buy a house and sell a house in just that much time. You spend most of your time trying to find a buyer and a seller. So that brings your choices down to 2, insurance policies or mutual funds, Dhirendra. What would you like him to do?
I would urge all viewers of our program that they should look at insurance as an expense and as an expense for buying protection for your family, just in case you are not around. If you have, few dependents or, anybody financially dependent on you, look at it as an expenditure, nothing beyond that. Mixing insurance and investment doesn't work. You can't, you don't get necessarily the best of anything. So don't mix your investment and insurance. So first go for your insurance and look at it as a completely different thing. It's not an investment. And for your investment, for this kind of time frame, I will be inclined to, I would like to discourage you to invest even in a balanced fund, because balanced fund is also almost like an equity fund, except that it can have 25, 30, 35% into fixed income. That provides it greater stability. But for 5 years time frame, I would be thinking in terms of, looking at, conservative allocation fund from our, conservative portfolio.
All right, our conservative portfolio is on your screen right now. If you have a question for Dhirendra Kumar about your investments or about anything else, it doesn't have to specifically be mutual funds, write to us. Our email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide in ET now. Thank you so much for staying with us. Dhirendra Kumar is still with us right now. It's time for our product review. And this week, we're looking at the UTI Dividend Yield Fund. Avan is going to give us a quick introduction into how the fund has performed specifically over the last 1 year. And then we'll come back and talk about it.
Thanks, Faye. This week, we focus on the UTI Dividend Yield Fund. And as the name suggests, the fund invests a large proportion of its portfolio in stocks and has a good track record of rewarding its investors with dividends. The fund's strategy rewards investors who seek steady returns and have a conservative approach to risk. The fund manager does not exit a company when the dividend yield falls below the Nifty index, but exits it only when the stock is highly overvalued or its fundamentals have deteriorated. 4 years ago, this fund was one of the top performers of the year on this show. But its track record over the last 3 years has been rather disappointing. The fund has not managed to beat its category average for 3 years, returning only 14% when the average has been 19%. While the fund's long-term returns over 7 years still place it at number 9 in its category, it has slipped to number 90 on the one-year return chart. Investors are disappointed, but should the traditionally loyal customers of UTI move on to greener pastures? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those details. Dhirendra, UTI Dividend Yield Fund used to be a top performer, used to be a fund that you personally recommended on this show 4 years ago, maybe 3 years ago. The performance has really slipped over the last 2 or 3 years, especially in the recovery we saw in the last calendar year. It hasn't managed to keep up even with its category average. And remember, the category average here is the middle of the pack, and this fund is falling way below the middle as well. What would you say to all of the loyal customers who've been investing in this fund for such a long time?
Yes, it has been disappointing. It has not recovered well. And I think it's time to really reconsider one's investment here. Of course, recently it has recovered well, but I look at it from 2 dimensions. When we look at it in the kind of funds with similar portfolios, not looking at it its mandate to be investing in high dividend yielding stocks. Keeping that aside, it falls into our large and mid cap category, and which means that it has 60% and more invested in large cap stocks. From that standpoint, in that category, it is not a promising. It has been a below average performer. Even comparing it to other dividend yield fund, and we have quite a few to compare with. Even there, it has been disappointing because most other dividend yield funds have kept their focus on relatively smaller companies or mid-sized companies in their chase in their effort to looking at higher yields. So this fund has been disappointing. It has, and for last 2 years, last 2 full calendar year, it has been not been able to beat its own benchmark, which is BSE 200. So I would say it's a below average fund as of now, and has shown some turnaround, some resurgence, but overall I would say it has been a disappointing fund, a below average performer.
So then, Dhirendra, are you saying, obviously there are better options out there, but are you saying that it's time to give up on this fund, pull our money out and move to those better options? I
think so, undoubtedly, because with the average risk, because this fund has also not been able to guard itself reasonably against the downside, and reasonably and below average return, it has not been able to participate in the turnaround in the market. So from that standpoint, yes, give up on this fund.
All right, give up on this fund. Dhirendra, the last time you reviewed the UTI Dividend Yield Fund on Investors Guide, you gave it 4 stars. Since then, on your website, Value Research, it's down to 2 stars. Would you like to, downgrade it on this show as well?
Yes, very much so.
2 stars there for the UTI Dividend Yield Fund on Investors Guide. Remember, it's rare that a fund gets such a strong review on the show. Dhirendra, they're telling you that if you're an investor in this fund, it's time to move your money out. Dhirendra, could you give our viewers an alternative fund to use if they have been using UTI Dividend Yield up till now?
A good substitute can be Birla Sun Life Dividend Yield, which looks quite promising. Besides that, you can also consider funds from our growth portfolio, the large and mid cap fund, the well diversified selections in that portfolio.
All right, let's move on now to our hold or sell segment. Abhishek has written in, he's 32 years old, married, monthly take home of 1.7 lakh rupees, 14 lakh rupees of which is invested in tax-free debt bonds. He now wants to increase his exposure to equity. So even though he's a young man, Dhirendra, he's a first-time equity investor. He tells us he has an investment horizon of 10 or 15 years and he's looking for an appreciation of 15% every year. He wants to know if his investments, the ones that he's picked out, will they be on track? Right on top is the ICICI Prudential Dynamic 20,000 rupees every month. This is a great fund, Dhirendra. Should he continue that investment?
Yeah, absolutely. And going by this fund's history, 15%. Of course, the rewards of being a disciplined investor could be much more than the return that you see from the fund over any time period. But still, I would say that yes, this is a great fund to have for such a goal. Important thing will be to remain focused on your savings, disciplined savings.
Well, he has picked very aggressive funds. The Franklin India Smaller Companies Fund is the next on his list, Dhirendra. 10,000 rupees going into that fund every month. Continue this investment as well?
Yeah, very much so. I would say that, looking at it in conjunction with 20,000 going into the earlier fund, which is more diverse. Of course, he will have to, appreciate that his money going in the smaller companies fund will be more volatile. And if he's looking at his portfolio in a lean market, it could be quite depressing, and it will be a challenge to, continue investing and without getting disappointed. But if he has that discipline, yes, it can prove very rewarding.
All right, I'm going to take the next two funds together. There's HDFC Mid Cap Opportunities and HDFC Top 200 funds, Dhirendra. Not too much of an overlap in the two, but should he continue with both of them?
Yes, very much so. If this portfolio is just made up of these four funds, all four funds are very promising. They are of different kind. They are complementary in a portfolio, and they have the least of overlap. So he has made a good choice. Also, I am quite impressed by his allocation. Getting into more money going into more diverse funds. So it's an excellent portfolio.
All right, so the funds that you've picked out are perfect for your goal. Dhirendra, they're giving you 2 thumbs up that you can continue with those investments. One last question, Dhirendra, before I wrap up this segment. Colonel Surendra Kumar Sethi has written in, he wants to invest 50,000 rupees a year over the next 5 years for his granddaughter for her higher education. He tells us that she's 1 year old now. That's a wonderful thing you're doing. He wants to know if he should be using the SBI Life Smart Scholar Plan. That's a very interesting name for a product, Dhirendra, but like you always say, you don't always have to pick a product just because it says Smart, Scholar, Life or anything else in it. Would he be better off just using a mutual fund?
Absolutely, and also to keep it simple and keep it tax efficient, he should choose one balanced fund, keep investing there for next 5 years, and going by the age of grandchildren, I think it has the potential to accumulate into something very sizable and also completely tax-free. And it is possible to invest in the name of the minor, and when the minor attains majority, it becomes a major. All this, this investment will be, inherited, can be acquired, will be in her name, and I think in 18-20 years' time, it can translate into something substantial. And it will be entirely tax-free.
All right, so those funds are on your screen right now. Dhirendra, they're saying tax-free, which means that when you pull the money out as well, there'll be absolutely no tax on it. Dhirendra, thank you so much for spending time with us this week and answering our questions.
Thank you.
Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. We've brought in Gajendra Kothari to answer the numerous questions you've sent in on insurance policies. Gajendra, thank you for joining us.
Thank you.
Our first question comes in from Rajan Srinivas, who writes in saying that he may have been missold the SBI Annuity Life Scheme or the Lifelong Pension Plan in 2004. He's very unhappy with the returns he's received because he's been investing this entire time and his return is about 5%. He wants to know if he should withdraw his investment right now. Gajendra, whether or not he was missold that policy. The truth is, there are several viewers right now who are unhappy with their insurance policies. What should we all do if we're holding a policy that we're unhappy with?
So, I think Rajan has been handed a wrong policy, if I can say so. He was advised a policy which is not so efficient in the retirement. This is a individual traditional plan, retirement plan. So the bulk of the money has always been invested into a debt instruments. 2004 he invested, and so he has withdrawn, I think, 1/3 now. The rest has to be compulsorily through annuity, which is again taxable and not very efficient. And IRD also mentioned that these insurance policies are to provide some kind of guaranteed returns. So most of the insurance companies have played it pretty safe. They have invested hardly any money in equity, to give a kind of a guaranteed return of 3 to 4%. So the only option I think at this stage is to surrender this policy as soon as possible. there's a charge of 1% which is very negligible now because he's completed almost 10 years. So I think he can come away with this policy. Whatever maturity proceeds he receives, he can think of other options like maybe a fixed deposit or other funds depending on his risk appetite. But I think this is not a good policy to continue, and the sooner you come out, the better it is.
Our next question comes in from Rajiv, who's 59 years old. He writes in from Kuwait. He says he has 25 lakh rupees in savings right now that he wants to put aside in a pension plan that will generate about 25,000 rupees every month after he retires in the next 5 to 6 years. Now, 5 to 6 years is not a very long time to be investing for your pension. A quick lesson for those of you who are watching who are in your 30s, you have to start now. And if you're in your 20s, even better. Let's come back now to Rajiv. He tells us HDFC Bank has offered him a pension plan called the Varishta Pension Bima Yojana from LIC. He's been told that the interest will be completely tax-free. He wants to know if he should go ahead with that plan. Gajendra, I'm not happy with him picking a pension plan so late in his retired life. I'd like him to use something slightly, more careful. What would you like him to do?
For Rajiv, since he's looking for investing 25 lakh rupees and he's hoping to get around 25,000 per month as the pension for lifetime, it basically works out to 3 lakh rupees per annum, which means the return from the investment should be around 12% per annum, tax-free, which can give him this amount. Now, he's looking at investing in Varishta Pension Bima Yojana from LIC, which has been recently introduced by the government. I don't think this is a right investment vehicle for him for two reasons. A, he cannot invest more than around 6 lakhs rupees into this pension scheme. There's a cap on the maximum investment amount. And secondly, the returns from this scheme works out somewhere between 9 to 9.38% return. And mind it, this is not tax-free. This is taxable returns. So from all angles, what Rajiv is looking at, none of these is fitting into the criteria. So I think rather the other option I would suggest is to go and invest into a balance fund wherein he can expect around 12 to 14% return over a longer duration, and that return would be tax free, and he can do an SWP so that every month 25,000 can keep coming to his bank account in his retirement.
Last question on the show is from Dinesh Satya, who writes in saying he has an income of 9 lakh rupees and a 1-year-old son to worry about and no life insurance. Well, that's the first thing we want to fix. Dinesh, buy life insurance of 10 times your annual income. Stretch that a little bit, make it 1 crore rupees. Won't be expensive at your age. Gajendra, can you help him pick out a policy?
So, Faye, I think I would like to congratulate Dinesh for initiating this particular thing, to take a term insurance. He's young, 34 years, married with 1-year-old kid. So term insurance is really called for at this stage, which will provide protection for his family. And because his income is decent, 9 lakhs per annum, so as the thumb rule says that you should have minimum of 10 times of an annual income. So the minimum cover which he should be having is at least 1 crore. Now because he is young and because he is healthy right now, I would recommend to go for the maximum cover possible. So most companies, insurance companies, can give him up to 20 times of his annual income. So in this case, I think he can easily get somewhere between 1.5 crore to 2 crores as term insurance cover. And at this age, the premium will also be very low. So just to give you a rough idea, for a 2 crore cover at 34 years of age, the premium would roughly be around 16 to 18,000 depending on the health condition, which I think is very reasonable. And you're locking this premium for a long time to come. Now, in terms of choosing the companies, frankly speaking, all these companies are regulated by IRDA, so you don't have to really worry. You should also ensure that you provide all correct information, and then no company would kind of deny the claim. When we go with, most of the times we try to go with settlement ratios. In my opinion, this is not a right figure to check, because this is not the settlement ratios for only term plans. This is for the entire bouquet of plans. So this doesn't give a true picture. And as I said earlier, if you're providing right information, we'll have no issues at the time of claim settlement, beat any company.
All right, that's a wrap on Investor's Guide. Gajendra, thank you for answering our questions. Thank you for sending in all the questions you sent in during the week. Remember, if you're a woman who's watching, we're always partial to our women viewers. We'll make sure we take your question on the show. Tune in next week to catch Investor's Guide. Thanks for watching.